Hello, and welcome back to Forex School from Pip Insight. This course is about the days when the chart stops whispering and starts shouting, news days. Here's our roadmap. We'll begin with a single sentence that explains why economic news moves currencies at all. Then we'll sort the economic calendar into the handful of releases that genuinely matter and the noise that doesn't. We'll unpick why a good number can send a currency down, the strange arithmetic of expectation versus actual. We'll dissect the anatomy of a news candle, the spike, the whip, and the true move. We'll study the 3 ways traders handle a red flag release, including the one nobody sells courses about, standing aside. We'll spend proper time on central bank days, and we'll close with an honest chapter about what news really does to spreads, stops, and small accounts. Grab a notebook, and let's begin. Before we open a single chart, one question needs a proper answer. Why does a number released from a government building move a currency within milliseconds? The answer is shorter than you'd expect, and it is the foundation of this entire course. Here it is, the sentence that explains 90% of what happens in foreign exchange. Money flows towards currencies whose interest rates are expected to rise, and away from currencies whose rates are expected to fall. That's the whole engine. Global capital is permanently hunting for yield, and a currency backed by rising rates simply pays its holders more to own it. Pension funds, banks, corporations, trillions shift on that arithmetic. Which means every economic release you will ever watch, inflation, jobs, growth, matters only insofar as it changes what the central bank is expected to do with rates next. Learn to hear that question underneath every headline, and the calendar stops being chaos and starts being a story. So how does a data release feed that rate story? Central banks have 2 obsessions, inflation and employment. When inflation runs hot, a strong CPI print, the bank comes under pressure to raise rates to cool things down, and traders buy the currency in anticipation. When jobs data disappoints, the bank leans towards cutting, and the currency gets sold. That's the chain: data, then expected policy, then currency flow. Notice something important: the currency moves on the expectation, long before the bank actually does anything. The rate decision itself is often the least surprising event of the cycle, because the data that shaped it was public for months. Keep that thought, it becomes crucial in Chapter 4. Open any economic calendar and you'll find 40 releases a day. Trying to care about all of them is a fast route to exhaustion. So let's build the tier list, the 3 or 4 events that actually move markets, and the long tail that almost never does. Tier 1, the red flags. Non-farm payrolls, the U.S. jobs report traders call NFP, released the first Friday of each month. CPI, the inflation report, because inflation is what central banks answer for. And the central bank decisions themselves, FOMC in America, the ECB, the BOE. These routinely move a pair 50 to 100 pips in minutes. Tier 2 moves markets sometimes: GDP, retail sales, employment surveys, worth knowing, rarely explosive. Everything else is Tier 3, minor surveys and revisions that markets shrug off. 2 practical rules. A release mainly moves the currencies it belongs to. And check the calendar before every session. The worst way to learn a red flag exists is mid-trade. Now for the idea that confuses every newcomer at least once: a strong economic number comes out, and the currency falls. How? Because markets don't trade good versus bad, they trade actual versus expected. Next to every calendar event sits a forecast, the market's collective guess. By release time, that guess is already in the price, traders bought or sold it weeks ago. So the only new information at 1:30 is the surprise, the gap between forecast and actual. A good number that's less good than forecast is a negative surprise, and price sells off. A dreadful number that's less dreadful than feared can rally. The market is a machine for pricing expectations, and news trading is the study of when those expectations are wrong. Here's the pricing in effect on a GBP/USD style chart, and it's the quietest story in this course. A rate rise is widely expected in 2 weeks' time. Watch the candles: no impulse, no drama, just a patient drift from 127 up to 127.86, 10 candles of the market steadily buying the expectation. Then the announcement lands, and it's exactly as forecast. Look at the event candle. It spikes to 128.10 and collapses, closing all the way down at 127.34. 2 candles later the pair trades at 126.86, below where the drift even began. Nothing went wrong with the news. The good news had simply been bought for a fortnight, so when the fact arrived, there was nobody left to buy it. Buy the rumor, sell the fact, this is what it looks like on a chart. So what actually happens on the chart in the seconds after a red flag release? It isn't one move, it's 3, and they arrive in a predictable order. Let's dissect a news candle properly. Every violent news reaction has 3 acts. Act 1, the spike. Algorithms read the number in microseconds and price leaps, often 30 or 50 pips before a human has finished reading the headline. Act 2, the whip. The first reaction gets challenged, profit-taking, second thoughts about the detail beneath the headline number, and price snaps back hard, sometimes clean through the other side of the range. Act 3, the true move. Once the detail is digested, the market picks its genuine direction, and that leg often travels further than the spike and lasts hours rather than seconds. The lesson hiding in this anatomy: the first move after news is frequently the wrong one. The close tells the truth, the wick tells the panic. Let's watch all 3 acts on one chart. Before the release, 6 quiet candles hold a tight range under 128.68, with support at 128.40. Then the number drops. Act 1, the huge candle marked as the spike explodes to 129.32, over 60 pips in one bar. But look at the close, 128.64, leaving an enormous wick. Buyers of that headline are already underwater. Act 2, the whip. The next candle stretches from 128.84 down to 128.36, punishing both sides. That boxed zone is where late buyers and early sellers were both shaken. And Act 3, the true move, a decisive close through the 128.40 support, that's the BOS, and price runs all the way to 127.36. The spike screamed up. The market meant down. Given that anatomy, traders have exactly 3 sensible responses to a red flag event, and all 3 deserve equal respect. Option 1, stand aside. Flat before the release, orders cancelled, hands off until the dust settles. It costs nothing, risks nothing, and misses only the most hostile minutes of the week. Option 2, fade the overreaction, wait for the spike to slam into a meaningful structural level, an old high or a well-tested zone, and trade the rejection back. Option 3, trade the post-news trend, let the spike and the whip finish, then join the true move once a genuine break holds. What no experienced framework recommends is the 4th option most beginners choose, guessing the number and gambling into the release itself. Here's the fade, and notice it only works because structure was drawn before the news. Earlier in the chart, a rally tops out at 129.48, an old high the whole market can see, then price pulls back for candles into the release. The number lands and the spike rips upward to 129.54, 6 pips through the old high, straight into the pool of stops resting above it, that's the sweep, and then the candle closes back at 129.32. The level held. Traders fading this aren't guessing the data, they're selling a known ceiling after an emotional overshoot. Watch the follow-through. Sellers press candle after candle, break the pre-news low at 128.62, the BOS, and the move finishes at 128.26. The news provided the fuel. Structure provided the location. And here's the other side of the coin, the breakout that holds, the trend after news case. Before the release, price tests 129 exactly twice and fails both times. That's the pre-news ceiling, marked across the chart. The number lands hard in one direction, and this event candle is different from our earlier spike. It drives to 129.78 and closes at 129.68, near its high, with barely any wick. That's the tell. Conviction candles close where they traveled. Then the market offers its polite entry. 2 candles later a pullback dips to 129.04, retesting the broken level, and buyers defend it immediately. From there the trend unfolds for hours, closing the chart at 130.14. Traders taking this route never touched the release itself, they joined a confirmed move at a retested level, after the dust had settled. Central bank days deserve their own chapter, because they're the only red flag that fires twice. First comes the statement, the rate decision and the written text, released to the second. Algorithms trade it instantly. But 30 to 45 minutes later comes the press conference, where the governor answers questions live, and one unscripted sentence about the path of future rates can matter more than the decision itself. Remember Chapter 2, Markets Price Expectations about the future, and the press conference is where the future gets discussed. This is why experienced traders treat the gap between statement and press conference as half-time, not full-time. The first move answers what the bank did. The second answers what it will do next, and that's the one that sticks. Watch a central bank day play out in full. For quiet candles hold above 128 exactly as the market waits. Then the statement drops, a surprise rate rise, and the candle marked as the statement launches from 128.10 to close at 128.68. The rally extends to 129.02, and anyone judging the day at halftime sees a straightforward bullish result. Then the governor sits down to speak. Asked about the path ahead, he hints this rise may be the last of the cycle, and the presser candle erases the entire statement move in one bar, closing at 127.92, straight through the pre-news floor. That's the BOS, and the slide continues to 127.34. The bank raised rates, and the currency fell, because the future changed more than the present did. Now the chapter this channel is known for, the honest one. Everything so far showed you what news trading can look like when it works. This is what the sales pages leave out. Here's what actually happens to your orders around a red flag release. Spreads blow out, a pair that normally costs 1 pip to trade can cost 10 or 20 in the seconds around the number, because market makers widen to protect themselves. Stop slip, a stop loss is a request, not a contract, and when price gaps 40 pips through your level, you're filled at the next available price, not the one you chose. And the spike itself is a race against firms with servers next to the exchange and algorithms reading the release in microseconds. Retail news scalping, trying to click faster than the machines, is a race a human enters last and finishes last. That's not pessimism, it's plumbing. And here is the chart that funds the industry, the whipsaw. Before the release, 5 candles hold a tidy range, ceiling 127.98, floor 127.62, drawn as the box. The number lands. First candle, a violent spike to 128.56, every stop above the range is taken, every breakout buyer is filled at the top, then it closes back inside at 127.92. Next candle, straight through the floor to 127.08, now the sell stops are gone and the breakout sellers are trapped too, before closing back at 127.26. Both sides stopped out inside 2 candles. And the punchline? For candles later price sits at 127.76, the middle of the original range. The market went precisely nowhere, and collected everyone's stops for the privilege. Traders who were flat watched this with a cup of tea. So let this course be the one that says it plainly, sitting out is a strategy. Flat is a position, it's the only position with a spread of 0, slippage of 0, and a heart rate of 0. The professionals you're competing against skip events constantly, they call it risk management, not cowardice. A simple, honest news routine looks like this: check the calendar each morning, be flat, or well away from your invalidation, before Tier 1 releases, let the spike and the whip finish, and only engage afterwards, at structure, where the earlier chapters apply. Nobody's equity curve was ever ruined by the trades they didn't take during a red flag release. Plenty were ruined by the ones they did. Let's gather the whole course into one view. Currencies follow interest rate expectations, money flows towards rates expected to rise, away from rates expected to fall, and every release matters only through that lens. The calendar has tiers, NFP, CPI, and central bank decisions are the red flags, most of the rest is noise. Markets trade the surprise, not the headline. The forecast is already in the price, which is why good news can sell off after a long pricing in drift. News candles arrive in 3 acts: spike, whip, then the true move, and the first move often lies. Traders have 3 respectable choices: stand aside, fade at structure, or join the post-news trend, and on central bank days, the press conference can overturn the statement. Above all, spreads widen, stops slip, and flat is a position. And that completes news and fundamentals. You can now read an economic calendar like a tier list, explain why a strong number can sink a currency, dissect a news candle into spike, whip, and true move, and choose deliberately between standing aside, fading at structure, or joining the settled trend. Your homework: for the next 2 weeks, mark every Tier 1 release before it happens and simply watch the 3 acts unfold. No trades, just observation with the calendar open. If this course earned it, subscribe and turn on notifications, because the next course takes these events into full trade planning. And the usual close, which matters more on news days than anywhere else: everything in this series is education, not financial advice. No method is a promise of profit, and trading carries real risk of loss. Practice on a demo first. The calendar will still be there when you're ready. See you in the next course.